While the AI gold rush is usually about selling software, it turns out you can also just sell $22 billion of picks and shovels in a single quarter. Today is March 19th, 2026, and we are looking at Accenture, ticker ACN, and their Q2 fiscal 2026 results, which are honestly kind of wild.
Very wild. They basically materialized nearly $4 billion in cash out of thin air just by telling clients to pay them faster.
Literally. They knocked 5 days off their billing cycle, and free cash flow surged by 143%, up to $3.67 billion. And just a quick reminder before Miro starts poking holes in the rest of the report, nothing we say here is financial advice, just our own personal, highly caffeinated opinions.
Right. Please do not restructure your portfolio based on my skepticism.
So let us look at the headline numbers, because the top line tells a totally different story than the cash flow. Revenue came in at $18.04 billion, which is up 8% year over year, but actually down 4% from last quarter.
And earnings per share followed right along, 2.93 a share. That is a 17% drop sequentially.
Plus, we saw operating margins compress 150 basis points down to 13.8%.
Up, actually. Sorry. They did expand slightly year over year, just 30 basis points. But yes, the sequential drops look very heavy on paper.
They do, but the stock completely ignored the quarterly weakness today. I mean, the shares were in a brutal downtrend for the last few months, dropping over 17% across the quarter. But then this morning, the regular session opens and the stock just surged, closed up almost 9%.
Because the market is looking past the immediate margins. Like the traditional consulting model, the whole giant IT services industry is essentially just throwing more bodies at a problem. You hire more consultants so you can bill more hours.
The classic linear body shop model.
Exactly. But Accenture is trying to detach from that. They want to decouple revenue from headcount. So they are aggressively buying up proprietary tech and subscription models.
Like their whole agentic AI focus, which is so fascinating because they're moving way past just selling chatbots that summarize emails. For example, they built this autonomous system for Radisson Hotels that actually handles live pricing and marketing on the fly.
And direct bookings tripled.
Which proves they're delivering AI that actually drives revenue.
That is the crucial part. It shows forward demand is real, which is why their new bookings hit a record $22.11 billion. The market loves that pivot to non-headcount growth, even if the sequential margins are currently getting squeezed by acquisitions and some weird geopolitical and government drags.
Okay, yes, the U.S. federal business acting as an anchor. We definitely need to unpack how that is hiding their true growth rate right now. All right, let's get into the detail.
Right. So if you look at the Americas segment, the headline growth was 3% year over year in local currency, which sounds completely mediocre for a tech services giant. But that includes the federal business dragging everything down.
Which is fascinating because usually government contracts are the ultimate safety net. But here it literally chopped their regional growth in half.
Exactly. Angie Park, the CFO, actually pointed this out. She said, excluding the 2% impact from the federal business, Americas grew approximately 6% in local currency. So the commercial sectors are actually, holding up fine.
Okay, but that makes me wonder about the cost of that commercial strength, because they are not just winning organic contracts. They are buying companies to get these capabilities.
Buying is a polite word. They are vacuuming up the market. I mean, they bumped their M&A budget to $5 billion for the year. But here's the friction point. They're paying a serious premium to do it.
Right, because every company with a SaaS or AI label in their pitch deck is suddenly worth double.
Yeah, the valuation bubble is real. And management knows it. The CFO said, quote, "In some cases, we are paying higher multiples than in the past. That said, we are intentionally shifting towards higher growth, higher margin assets."
Okay, so wait. I mean, sure, that sounds great in a press release. You buy higher margins. But how is that impacting the balance sheet right now? Because we saw operating margins actually compress sequentially.
Right, down 150 basis points from Q1. But what caught my eye is how they're retaining the talent from these acquisitions. You look at their share-based compensation expense. It spiked over 50% quarter over quarter, from roughly $469 million to, $713 million.
Jeez, $700 million in one quarter? That is a lot of stock just to keep engineers from jumping ship.
It is massive. It shows that securing the intellectual property is only half the battle. You have to buy the loyalty of the people who actually know how to run it.
Which actually ties back to what they're doing with this tech, because it feels like they are moving into areas that consultancies usually avoid. Like, they're not just helping clients set up cloud software anymore. They're literally gutting 30-year-old mainframes.
Which is historically a nightmare. Nobody wants to touch mainframe code. It is a terrifying knot of legacy risk.
But AI changes the math on that. Julie Sweet made this really profound point on the call. She said, for decades, parts of the technology stack, like the mainframe, have been considered too complex or too costly to modernize. But today, advanced AI makes it feasible.
Right. They use code translation models to do the heavy lifting, which opens up this massive unaddressed market. Think about banks. Think about airlines. They're all running on ancient infrastructure.
The kind that fails and grounds every flight for a weekend.
Precisely. And if Accenture can use AI to finally rip out that old plumbing without breaking the house, clients will pay whatever they ask. So maybe those high M&A premiums are justified if it unlocks a completely new scale of modernization projects.
That makes a lot of sense. So you eat the short-term acquisition pain and the stock-based comp because the prize is getting the keys to the kingdom of enterprise infrastructure.
That is the bed.
Okay, so looking ahead then, how do these massive investments and the federal drag play out for the rest of the year? Where does this actually leave them heading into the next few quarters?
Well, management is actually pretty bullish. They tightened their full-year revenue growth target to a 3 to 5% range in local currency.
So they assume the federal drag just, fades out completely?
Pretty much. They expect those comparisons to normalize by the fourth quarter. But honestly, the bigger flex is the cash. They raised their free cash flow guidance by a full $1 billion.
$1 billion extra just from efficiency. That is wild.
Yeah, up to that $10.8 to $11.5 billion range. It provides this massive cushion to fund the entire transformation.
Right. And it really feels like they are making an almost historic bet here, not just on the quarter, but on the whole era. Julie Sweet literally said on the call that AI might turn out to be the most powerful technology breakthrough since electricity.
Which is heavy, but look, if you truly believe you are dealing with the next electricity, you do not just hire more guys with tool belts, you buy the grid. And that is exactly what they're doing with this shift away from billable headcount. They want the software assets.
There are still massive blind spots, though, right? Like, they explicitly noted in the guidance that these projections completely exclude any significant geopolitical escalation in the Middle East.
Yeah, it's essentially an admission that if macro stability breaks, this entire growth model breaks with it. They have roughly $1 billion of revenue tied up in that region.
So it's a bit of a high wire act. They're building a completely new economic engine while still charging top dollar to keep the old one running.
Yeah, and paying premium multiples for all the new parts. But hey, so far the cash flow is covering the tab.
For now, anyway, we'll definitely see if the math holds up next quarter. I think that's probably a perfect place to leave it for today. Anyway, if you want these earnings chats to just quietly show up in your feed, go ahead and hit follow. And as a quick reminder, this whole project is generated with AI to see if algorithms can actually hold a genuine conversation. So if there is a ticker you want us to pull apart next, or you just want to tell Miro he is wrong, drop us a line at earningsunscripted@datamadness.ca. Thanks so much for listening, and we will catch you next time.
Good luck with that. See ya.